What if I told you that one of the most sophisticated inflation-proof pension fund portfolios in the world was built by a guy who basically just guessed?
I mean, I'd say that sounds completely absurd.
Hmm.
Modern finance tells us that to build something truly resilient, you need like a PhD, a skyscraper full of analysts, and a supercomputer running risk algorithms 24/7.
Right. But today, for you listening, we are going to prove that might not actually be the case. Welcome to today's deep dive.
Glad to be here.
We are jumping into a really fascinating set of notes based on Chapter 9 of Gregory Scola's audiobook, The Leaking Pound.
How to build your wealth and the mystery of money that quietly disappears.
Exactly. And our specific mission today is to conduct what the financial world calls a look-through view. We want to figure out how this one very particular portfolio, which was designed to stop your money from just quietly evaporating, is actually constructed beneath the surface.
And that look through a view is just such a crucial concept because think of buying an index fund or an ETF like buying a newly built house. You walk up, you see the beautiful paint, the nice windows, and you think, great, I own a solid house. But the look-through view is when you demand to see the architectural blueprints. You want to know if the foundation underneath all that drywall is made of reinforced concrete or just, you know, cheap rotting plywood.
That is a perfect way to put it, because when you buy a fund, you are buying a basket of stocks.
Right.
But what happens when you own 10 different funds? You might think you're incredibly diversified because you have 10 baskets. But the blueprint, the look-through view, often reveals that all 10 of those baskets are just holding the exact same 5 companies.
Yeah, which is terrifying if one of them tanks.
Exactly. So today we are grabbing the blueprints of Skula's portfolio. We're going to figure out how this structure actually functions when you peel back the layers.
It's a phenomenal case study because as we do this, we're going to uncover a setup that mimics the most elite institutional wealth strategies on the planet. And yet the underlying logic is just surprisingly accessible.
All right, let's unpack this. Starting with the very first layer of our blueprint, which is the individual company exposure. When we run the diagnostic on Skola's portfolio, the top holdings look incredibly familiar.
I bet.
Yeah, at the absolute peak, we have Microsoft sitting at about 3 to 4% of the total pie. Apple is standing right next to it, also at 3 to 4%.
The usual suspects.
Right. And then we step down just slightly. We see Nvidia at roughly 2 to 3%. Amazon is right there at 2 to 3% too. Alphabet, which is Google's parent company, is also at 2 to 3%. And to round out the big tech names, we've got Meta and Tesla sitting at about 1 to 2% each.
What's fascinating here is just the sheer gravitational pull of what we call the U.S. megacaps.
Explain that term for the listener.
Sure. So a megacap is really just industry jargon for a company with a market capitalization of over $200 billion, meaning its total stock market value is just massive. Yeah. And the reality of modern investing is that these companies are so big that if you are buying broad global funds to diversify, you're inevitably going to scoop up a massive chunk of them. Their size just makes them unavoidable.
But the blueprint also shows us it's not exclusively Silicon Valley at the top.
Oh, right.
Yeah, sitting right there in the mix with the tech giants, we have the ultimate old guard. Johnson & Johnson is holding steady at 1 to 2%. Procter & Gamble is at 1 to 2%. ExxonMobil is 1 to 2%.
Which introduces the very first hint of structural balance in this portfolio. You have the aggressive digital frontier sitting right alongside the physical everyday economy.
Wait, hold on. I have to push back on this a bit.
Okay, go for it.
Because I am looking at those top companies, and if I'm the listener trying to protect my wealth from the leaking pound, I'm getting a little nervous here.
Why is that?
Well, if our top exposures are Microsoft, Apple, Nvidia, and Amazon, are we just building a disguised, highly volatile tech fund? Like, if the AI bubble bursts or Silicon Valley has a terrible decade, doesn't this supposedly safe portfolio just completely collapse?
That's a really valid concern.
Right. How does relying heavily on aggressive tech stocks protect anyone's wealth?
It's a trap a lot of amateur investors fall into, honestly. They stop their analysis at the top 10 list. To see the actual defense mechanism, we have to zoom out from individual companies and look at the broader sector exposure.
Okay.
When we shift the lens to how the entire portfolio is divided up by industry, that illusion of this being a giant, risky tech fund completely shatters.
Give us the numbers then. Let's hear it.
So the data reveals that technology only makes up about 22 to 27% of this entire portfolio.
Wait, let me stop you there.
Yeah.
Because for someone who isn't staring at financial charts all day, 25% might still sound like a huge chunk of money to put into just one sector.
Well, in isolation perhaps. But context is everything here. Scola's text explicitly notes that most standard equity-heavy portfolios today sit at a massive 40 to 50% tech allocation.
Wow. Half the portfolio.
Literally half.
Yeah.
If you just go out and blindly buy an S&P 500 index fund right now, you are essentially letting a handful of tech executives dictate the fate of almost half your money.
Oh, wow. Okay, so by actively restraining tech to roughly 25%, the portfolio is basically putting a governor on the engine.
Exactly.
It's saying, we want the growth, but we refuse to let it hijack the vehicle.
Precisely. And the genius of that restraint becomes so obvious when you look at how the remaining 75% of the portfolio is deployed.
Let's look at those other sectors, because instead of just, reading off a long list of percentages, I want to look at how they interact.
Yeah, let's do that.
The text notes that consumer staples make up 12 to 14% of the portfolio. Healthcare is roughly 9 to 10%. And utilities are around 5 to 6%. So how do those specific sectors physically act as a shock absorber against that tech volatility we just talked about?
So think about human behavior during a massive economic crisis. Let's say interest rates spike, tech companies start laying off thousands of workers, and the stock of a company like NVIDIA takes a massive hit.
People panic. They stop buying luxury items.
They absolutely do.
Yeah.
They cancel their software subscriptions. They delay buying the new iPhone. Businesses stop upgrading their cloud servers. Tech suffers.
Right.
But, and this is the crucial part, no matter how bad the economy gets, people still need to brush their teeth.
Yeah, that's true.
They still need to wash their hair, and they still need toilet paper. That is your consumer staple sector, companies like Procter & Gamble. People also still need their heart medication and diabetes treatments. That is your healthcare sector.
And they still need to keep the lights on in their homes.
Exactly. That's your utilities sector.
So when the tech side of the portfolio drops, the consumer staples and utility sides act as the ballast.
Yes.
They don't typically grow as fast as tech during a boom, but they physically prevent your wealth from plummeting during a bust because their revenue streams are practically guaranteed by basic human survival.
If we connect this to the bigger picture, this is exactly how you fight the leaking pound. Scola explicitly writes in the text, "That is the way I wanted it." This sector balance isn't a happy accident.
He intentionally built an ecosystem.
He did. The tech sector is your offense. It grows your money faster than inflation can eat it. But the staples, healthcare, and industrials, which sit at 10 to 11%, they're your defense. They ensure your wealth doesn't get wiped out by a single bad news cycle out of Silicon Valley.
Okay, that makes complete sense. We have this robust, balanced engine where different gears take the strain depending on the economic weather. But I see a potential flaw here.
Oh?
What if the shock isn't an industry crashing? What if it's a currency crashing? Because a consumer staple company operating in Ohio still goes down if the US dollar completely tanks or the American economy freezes. Does Scola's setup protect us from a purely geographical collapse?
That is an excellent question. And it transitions us perfectly to the next layer of our blueprint, which is geographic exposure.
Yeah.
Because like you said, balancing your industries is pretty useless if all those industries are physically located on a sinking ship.
Let's map out the money. The geographical breakdown from the X-ray shows the United States holds the lion's share, sitting at 55 to 60% of the equity exposure.
Right.
Then we cross the Atlantic. Europe is at roughly 18 to 22%. Emerging markets make up 12 to 15%. Japan sits at 5 to 6%. The UK is 4 to 6%. And other developed countries round it out at about 3 to 4%.
Now, looking at those numbers, what is your immediate instinct about that U.S. allocation?
Well, putting almost 60% of the money into America looks like a massive bet. It looks like the portfolio is saying the U.S. is the undisputed king of the global economy, and we are betting the farm that it will just continually outperform Europe and Asia forever. It feels like a huge home country bias.
That is a really common assumption, but I'd actually frame it in an entirely different way. It isn't a bet at all. In fact, it is the exact opposite of a bet.
Wait, how so?
Those specific percentages perfectly mirror actual global market weights.
Explain that. What do you mean by global market weight?
If you were to take every single publicly traded company on Earth in every country and put their total values into one giant pot, about 60% of the value of that pot would be made up of U.S. companies.
Oh, wow.
Yeah, and the remaining 40% would be companies from the rest of the world.
Oh, I see. So the portfolio isn't overweighting America because it loves America. It's just accurately reflecting the reality of the globe's financial distribution as it exists right now.
Exactly. It's a philosophy of supreme humility. The portfolio builder is basically acknowledging, I cannot predict the future. I don't know if Japan is going to have an economic renaissance, or if Europe is going to surge, or if the U.S. will maintain its dominance.
Right. Nobody knows.
Exactly. So instead of trying to guess who wins, you just own a proportionate slice of everything.
That's like walking into a massive casino. Most amateur investors go in and try to guess which specific roulette table is going to have a hot streak. They put all their chips on a specific country.
Yeah, which is super risky.
But this portfolio refuses to play that game. It just buys a tiny piece of the entire casino. If the American table goes cold, but the European table gets hot, your wealth is protected because you own a piece of both. You are just mirroring the house.
That's a great analogy. And that includes taking calculated, proportionate risks in faster growing areas too.
Yeah.
You mentioned emerging markets sit at 12 to 15%.
Yeah.
For the listener, an emerging market refers to economies in developing nations, places like India, Brazil, or Taiwan. They are inherently more volatile than established markets like the UK or Japan. They carry higher political risks and currency fluctuations.
But they also offer explosive growth potential as those nations industrialize and, their middle classes expand.
Right, and by anchoring them at that 15% mark, the portfolio captures that rapid, demographic-driven growth without letting the volatility of those developing regions destabilize the entire ship. Again, it just comes back to that architectural balance.
Okay, so we've looked at the specific companies. We've looked at how the sectors interact to absorb shocks. We've mapped out the geography to ensure we aren't tied to a single country's fate.
Yep.
But here's where it gets really interesting. We need to move away from equities from the stock market entirely and look at the deepest final layer of the look-through view, the asset class exposure.
This is the bedrock of the entire blueprint. This is the layer that separates a mere collection of stocks from a true multi-generational wealth preservation vehicle.
Let's lay out these final ingredients. When you look at the total pie across all asset classes, global equities, everything we just talked about, make up roughly 57% of the portfolio.
Okay.
So just over half is in the stock market. But the remaining 43% is where the real defense against the leaking pound lives. Bonds are at approximately 16%, real estate is 8%, gold and commodities are 7%, inflation bonds are explicitly carved out at 6%, utilities and energy infrastructure are at 5%, and defense and resources sit at 4%.
When you look at that specific mix, this is absolutely not your typical retail investor's setup.
No, your average person with a brokerage app usually just throws all their money into an S&P 500 fund, buys a few tech stocks they like, and just white knuckles it when the market drops.
Exactly. Retail investors rarely go out of their way to carefully balance traditional government bonds with a specific 7% allocation to physical gold and commodities, while also dedicating a highly specific 6% purely to inflation bonds.
It's super deliberate.
Very. This specific layout looks almost identical to a multi-asset institutional portfolio. Specifically, it mirrors a pension fund.
Let's dig into that, because the whole premise of Skola's book is fighting the mystery of money that quietly disappears, which is inflation. Why do pension funds use this exact complex mix of asset classes?
Think about what a pension fund has to achieve. Their entire existence relies on a single, terrifying mandate.
Yeah.
They have to reliably protect purchasing power over decades so they can actually pay thousands of people their retirement money 20, 30, or 40 years from now.
Right.
If inflation averages 3% a year, the value of their cash is getting decimated. They are the ultimate warriors against the leaking pound.
So they use that 57% in global equities as their engine. That provides the aggressive growth needed to outpace inflation.
But an engine is dangerous without brakes and a heavy chassis. That's what the other 43% does. Bonds provide fixed, reliable income when the stock market goes sideways. Real estate and physical gold act as hard asset anchors.
But so you can physically touch them.
Exactly. Historically, when fiat currency loses its value, tangible things land, gold, raw commodities hold their value.
I want to pause on one very specific item in that list. Inflation bonds, sitting at 6%.
Yeah, that's a key piece.
Wait, for the listener who isn't a Wall Street bond trader, How does a bond physically track inflation? Like, if the cost of milk and eggs goes up at the grocery store, does the payout of an inflation bond actually scale up with it? How does that mechanism work?
It's a brilliant piece of financial engineering, honestly. Traditional bonds pay you a fixed interest rate. So if inflation spikes, the fixed cash you receive buys less and less over time.
It's losing value.
Right. But an inflation-linked bond, like a TPS in the United States, which stands for Treasury Inflation Protected Securities, functions differently. The underlying principal value of the bond is legally tied to a national inflation metric, like the Consumer Price Index.
Wait, really? So as the cost of milk, gas, and rent goes up, the core value of the bond mathematically adjusts upward to match it.
Yes. And because the interest you are paid is a percentage of that underlying principal, your interest payments increase as well. It is a literal mechanical shield against currency devaluation.
Yeah.
And Scola deliberately dedicated 6% of his total wealth purely to that specific mechanism.
So what does this all mean? We have unrolled the blueprints of this portfolio, and we found a masterpiece of structural engineering. It utilizes the immense growth power of top-tier tech companies, but physically restrains them to 25% to ensure robust real-world sector balance.
Right.
It perfectly mirrors the 60-40 global geographic reality, so it never bets on one single country. And it utilizes an asset class mix identical to a multi-billion-dollar institutional pension fund to mechanically fight off inflation.
It is, by all traditional metrics, a masterclass in disciplined portfolio construction.
Which brings us to the most shocking sentence in the entire text.
There we go.
Gregory Scola explicitly states that he achieved this highly disciplined, institutional-grade setup entirely intuitively. He created this fortress, in his own words, without any substantial stock market knowledge.
That is the realization that completely shifts your paradigm.
It's wild to think about. You have literally armies of analysts and Wall Street skyscrapers running supercomputers, utilizing advanced calculus to arrive at these exact percentages for optimal risk-adjusted returns. And Scola just arrived at the exact same destination using common sense.
This raises an important question. Do we, as a society, completely overcomplicate the mechanics of investing? Because when you really break it down, Scola's intuitive approach wasn't magic. It was driven by a basic human desire for balance and safety.
Let's trace his logic, because it is surprisingly simple when you strip away the jargon. He knew his money was leaking due to inflation.
Yeah.
Common sense dictates that you need growth to outpace that leak. Hence the 57% allocation to global equities.
But common sense also dictates the oldest rule in the book. Don't put all your eggs in one basket. That intuitive fear of ruin naturally leads to reducing your tech exposure and balancing out the different sectors of the economy.
Exactly. And common sense also says that you shouldn't tie your entire life savings to the fate of one single government or one single currency, which naturally leads to spreading your money across the globe, landing right on that 60-40 geographic split.
And finally, a primal understanding of risk tells you that digital numbers on a screen aren't always real. If the system fails, you want to own things you can touch. Land, gold, energy.
The tangible stuff.
Right. That intuitive desire for tangible safety resulted in the exact multi-asset mix that pension funds use to survive economic winters.
He didn't need a PhD in macroeconomic theory to realize that if you want to build a structure meant to stand for 100 years, you need a wide base, deep foundations, and a lot of different sturdy materials.
It turns out that a genuine, disciplined desire to protect what you have naturally mimics the highest levels of institutional finance. The math simply aligns with the intuition.
It completely reframes how you look at the entire financial industry. So to bring this all together for you listening, by taking a look-through view of this portfolio, we didn't just find a random, chaotic collection of stocks thrown together by an amateur.
Not at all.
We found an architectural marvel, a structure that fully embraces technological growth but stubbornly insists on balance at every single level. Sector balance, geographic balance, asset class balance. It is an institutional fortress built to withstand a leaking currency, constructed entirely with disciplined intuition.
The blueprint proved that underneath the noise of daily market news, the fundamental rules of protecting your wealth haven't actually changed. And more importantly, they are accessible to anyone willing to apply a little grounded common sense.
Which leaves you with something pretty profound to think about today. If someone without substantial stock market knowledge can intuitively build a portfolio that perfectly mirrors the most sophisticated pension funds in the world simply by aiming for logical balance and inflation protection, What does that say about the highly expensive, actively managed financial advisory industry? Are we out there paying experts astronomical fees to unlock complex, hidden Wall Street secrets, or are we simply paying them a premium to execute the exact same common sense that we might already intuitively possess?